Welcome back to the deep dive. I want to start today with a feeling that I think we all have, probably daily at this point. You open your laptop, you check the news, you look at a report for work, and it just hits you. We are just drowning in data.
Oh, completely. It's the modern condition, isn't it? We have more information than any human could process in 1,000 lifetimes.
Right. And it's not just that there's a lot of it, it's that it's messy. You've got economic trends, financial shifts, endless rows of numbers, and the challenge isn't it's not finding the data anymore. It's figuring out, does any of this actually mean anything?
That is the trillion-dollar question.
How do you go from staring at a chaotic spreadsheet to actually predicting the future? Or making some high-stakes policy decision?
Well, you can't, not with just the spreadsheet, because data without a structure, without a model, is just noise. It's static.
You have to organize.
You have to organize it to make it useful.
Yeah. And that brings us right to our focus for this deep dive. We are digging into econometric modeling and specifically the software tool that seems to be the standard for this, EViews.
Yeah, EViews is fascinating because it's really the bridge between those raw, messy numbers and, actionable economic strategy.
So our mission today is to demystify this. We want to understand how students, economists, Wall Street pros, how they turn raw data into actual insights. But before we jump into the software, I want to push back a bit. Econometric modeling just sounds so academic. What are we really talking about? Is it just fancy statistics?
It is fancy statistics, but with a very specific purpose. The definition is, a quantitative approach using statistical techniques to analyze economic data. But the key difference between this and just doing stats is the goal.
Which is?
Testing hypotheses and forecasting. You aren't just describing what happened yesterday. You're trying to build a mathematical representation of the world.
A model.
A model, exactly. To see what happens if you pull a specific lever. You're using history to try and predict the future.
Okay, so crystal ball built out of math. But here's my question, and I feel like a lot of people listening are probably thinking this. Why do we need special software? I mean, everyone has Excel. I can run a regression in Excel. Why is EViews the gold standard?
That's a fair question, but if you've ever tried to run a complex time series model in Excel, you know the answer. It's the difference between a static spreadsheet and a dynamic engine. EViews is built for computational power and time intelligence.
Time intelligence. What's that?
Think about it. Economic data is almost always tied to time, right? GDP last quarter, inflation this month.
Stock prices today.
Stock prices today. EViews understands that yesterday happened before today. It has built-in functions, like lag operators, that let you easily ask, how does last month's interest rate affect this month's housing prices? Doing that in a spreadsheet is a nightmare of fragile formulas. In EViews, it's the native language.
So Excel is like a handsaw, and EViews is a laser cutter.
Precisely. It frees you from the manual arithmetic. You aren't worried about whether you copied the formula down correctly. You're worried about, is this model actually telling me the truth? It shifts your brain from calculation to
interpretation. Okay, let's get into the toolkit then. We're sitting in front of EViews. We have our data. What's the first thing we build? The source starts with simple regression.
This is the foundation, and it's exactly what it sounds like. You're looking at the relationship between just two variables. One is the dependent variable, the thing you're trying to explain, and the other is the independent variable, the thing doing the explaining.
Give me a concrete example.
The classic one is grades. If I want to predict your GPA, I might look at hours spent studying. Variable A affects variable B.
Simple enough. I study more, my grade goes up. EViews draws a line through the data, and that line shows the relationship.
Right. But, and this is where the economist in me has to jump in, that model is almost certainly wrong.
Why? I studied, I got an A.
It works. Because the world is rarely that simple. If you only look at study time, you're ignoring everything else. What if you didn't sleep? What if you were sick? What if the class is just really easy? You're attributing all the success to study time, which might be misleading. And this brings us to multiple regression.
Which I'm guessing means adding more variables.
Exactly. And this gets to a really important concept called ceteris paribus, all else being equal. In the real world, say, the stock market, you can't just look at one thing. To model Apple's stock price, you can't just look at iPhone sales.
Right, because interest rates might be rising,
right,
or there could be a tech crash.
Or consumer sentiment is down.
Correct. Yeah.
So multiple regression lets you put all those variables into the blender at once. It mathematically isolates the impact of iPhone sales while holding everything else constant. It gives you a much more nuanced understanding of what's actually driving the bus.
So it tells you, okay, even if the economy is crashing, How much does selling one more iPhone help the stock?
Yes, it separates that one signal from all the noise of the rest of the world.
That sounds powerful, but it also sounds a little dangerous. If I can just dump 50 variables into eViews, how do I know I'm not just seeing patterns that aren't there? I feel like if you look at enough data, you can find a correlation between anything, like sunspots cause recessions.
That is the danger, spurious correlations. And that's why eViews isn't just a calculator, it's a laboratory for hypothesis testing. You don't just assume your theory is right.
You have to prove it.
You have to prove it. This is the scientific method part. We use tools like t-tests and f-tests to determine statistical significance. Basically, the software looks at the relationship and asks, is this result reliable, or could it have just happened by random chance?
So if you can't pass the test,
Your theory goes in the trash. It's innocent until proven guilty, but for math.
okay. But even if my variables are significant, the model itself can still be broken, right? And this seems like a huge part of the workflow. Diagnostic tests.
It's critical.
The source listed 3 terms here that honestly sound like medical conditions: multicollinearity, heteroscedasticity, and autocorrelation. I think we need to spend a minute on these. They seem like the big 3 deal breakers.
They are the big 3. If your model has these, your model is sick.
Let's start with multicollinearity.
Okay, so remember our Apple stock model. Let's say you put in iPhone sales as one variable and revenue from iPhones as another.
Okay, but those are basically the same thing. If I sell more phones, I make more revenue.
Right. They move together almost perfectly. That's multicollinearity. The math breaks down because the model can't tell which one is actually causing the change. It gets confused.
Yeah.
You need independent variables that are actually independent.
Got it. Don't ask the same question twice in different words. What about the second one?
Heterotero.
Heteroscedasticity.
Heteroscedasticity.
Right.
That is a mouthful.
It's a great Scrabble word. Hetero means different. Sedastic refers to scattering. This is about consistency in your errors.
Okay, plain English, please. Imagine you're trying to model how much families spend on food based on their income. Low-income families. They have very little choice. They spend what they must. The variance is low. But high-income families. Some might save everything and eat beans. Others might eat caviar every night. The variance is huge.
So the reliability of your prediction changes depending on who you're looking at.
Exactly. If your model assumes the error is constant everywhere, but it's actually exploding at the high end, your risk assessment is going to be totally wrong. eViews has specific tests to spot this.
Okay, and the last one, autocorrelation. This sounds like it has something to do with time.
It does. This is critical for anyone in finance. Autocorrelation happens when today's value is correlated with yesterday's value. Think about stock prices or inflation. If inflation is high this month, it's probably going to be high next month. It's sticky.
So the errors aren't random. They're following a pattern.
Right. And if you ignore that, you might think your model is incredibly accurate when it's really just riding the wave of the previous data point.
Yeah.
You're not predicting the turn, you're just echoing the past.
Okay, so we've built the model, we've run the diagnostics, we've made sure we aren't committing any statistical crimes. Now we hit enter and eViews spits out the result. And this is where I think people get overwhelmed. It's just a wall of numbers.
The output window. Yeah, it can be intimidating.
So let's decode it.
Yeah.
What are the tea leaves we need to read? The source highlights coefficients first.
The coefficient is the story number. It tells you the strength and the direction. If the coefficient for interest rates in a housing model is, say, negative 0.5, it tells you direction. Rates go up, housing goes down. And it tells you strength. For every 1% hike in rates, housing drops by 0.5%.
That's the so what number, the magnitude.
Exactly. But you can't trust it unless you look at the p-value and the t-statistic. This goes back to hypothesis testing. You might see a huge coefficient, but if the p-value is 0.4,
it's statistically meaningless.
it's trash. It means there's a 40% chance that result is just noise. You generally want a p-value below 0.05. That gives you 95% confidence that the relationship is real.
So checking the p-value is like checking the variable's ID. Now, what about the big score at the bottom, R squared? Remember this from stats class. We want this to be close to 1, right?
Yeah,
100%.
Yes and no. R squared measures how much of the variability your model explains. If it's 0.8, your model explains 80% of what's going on. That sounds great.
But I'm hearing a but coming.
But if you see an R squared of 0.99 in a social science or finance model, run.
Too good to be true.
Almost certainly a spurious regression. You're probably modeling something against itself, or you fell into that autocorrelation trap. In the real world, human behavior and markets are messy. A lower R-squared can actually be more honest.
That is a really important nuance. Don't just chase the high score.
Please don't.
So let's take all this out of the classroom. We've talked about grades and Apple stock. I want to walk through a real-world scenario. Where is it actually used?
Let's go to the absolute top of the financial food chain, monetary policy.
The Federal Reserve.
The Fed. Imagine you're an economist there. Your job is to decide whether to raise interest rates. You can't just go with a gut feeling. You're looking at things like the Phillips curve, the relationship between unemployment and inflation.
So you pull up EViews.
You pull up EViews. You load in decades of data, unemployment rates, inflation numbers, wage growth, oil prices, all of it. You run a model to see, if we raise rates by a quarter point, what does history say will happen to unemployment in 6 months?
And the model gives you a forecast.
It gives you a range of possibilities. It lets you simulate scenarios. Scenario A, oil prices spike. Scenario B, the labor market cools. This is where the F statistic from the output comes in. It tells you if the whole model is valid. They use these outputs to debate policy.
So when we hear on the news the Fed projects inflation will fall to 2%, that number came out of something like this.
Almost certainly. And then on the flip side, go to Wall Street. A hedge fund analyst isn't setting policy, they're just trying to beat the market.
Financial performance?
Right. They might build a model in EViews that looks at the spread between corporate bonds and government bonds to predict a recession. If their model flashes a warning, they sell stocks. If they're right, they make billions. But if their model had, say, heteroscedasticity, and they missed it,
They lose their shirt.
they lose everything. So the stakes of getting those diagnostics right are incredibly high.
This brings us to the final piece. We've done the math, we've run the model, but the source material has this whole section on the art of reporting. And I thought that was interesting because usually math people just stop at the answer.
But the answer is useless if you can't sell it.
Right. The source emphasizes communicating the findings.
Think about that Fed meeting again. The chair of the Federal Reserve doesn't want to see a raw EViews log file with t-stats and p-values. They want to know, what's the trend? What's the risk?
So how does EViews help with that?
Well, it lets you export high-quality visuals, tables, graphs. But the key, and the source makes a big point of this, is following best practices.
Don't just dump a table into a Word doc.
Oh, please don't. It mentions significant figures. This is a pet peeve of every senior economist. If your model predicts inflation will be 2.456789%, and you put that in the report,
You look like an amateur.
you do, because you can't possibly be that precise. It implies a level of certainty that just doesn't exist. Round it to 2.5%. Be honest about the margin of error.
And it also talked about layman's terms.
This is the human element. You have to translate the math. Instead of saying the coefficient of X is statistically significant at the 1% level, you say.
We have strong evidence that raising rates will lower inflation.
Exactly. You translate the data into English. You tell the story of the data.
That seems to be the theme here. We started this talking about a world awash with data. And the solution isn't just more math.
No, the math is just the tool.
So let's wrap this up. We've moved from messy Excel sheets to the power of EViews. We've talked about the big three diagnostics that keep us honest. And we've seen how this drives decisions from the Fed all the way to Wall Street.
It's a complete workflow. Accuracy, verification, and then communication.
I want to leave our listeners with one final thought to mull over. We always hear that AI and software are going to replace jobs. And looking at EViews, it does a lot of the heavy lifting. It runs the regressions, it checks for errors.
It does the work that used to take armies of human computers.
So if the software does all the computing, what's left for the economist?
Interpretation.
Exactly. It feels like the value of an economist is shifting entirely from computing to storytelling.
I agree completely. In a world where access to data and models is being democratized, the person who wins isn't the one who can run the regression. It's the one who knows which variables to put in the blender in the first place, and who can explain why the result matters to another human being.
The machine gives you the numbers, but you have to provide the meaning.
Meaning is the one thing you can't automate.
Something to think about the next time you're trying to predict the future. Thanks for helping us decode the numbers today.
Always a pleasure.
And thank you for listening. We'll see you on the next deep dive.